So, you're selling your house in India. Or maybe you just have. That's huge. But right after the celebration, another thought probably pops in your head. The tax bill. You've made a profit, which is fantastic, but how much of that do you actually get to keep? Well, today we are going to break down exactly how you can legally and significantly reduce that tax. Let's dive right in.
Here's a quick look at our game plan. First, we'll talk about the problem every home seller faces. Then, we'll introduce the solution, a little something called Section 54. We'll get into the nitty-gritty of the rules, the all-important timelines, and of course, how much you can actually save. And we'll wrap up with some pro tips so you don't make any costly mistakes. Sound good? Let's go!
Okay, so picture this. You've navigated the whole selling process. The papers are signed, the deal is closed, and you see that big number in your bank account. It feels great, right? But then, there's that nagging feeling. You know that a slice of that profit isn't really yours. That right there is the classic home seller's dilemma.
And this is the exact question we're here to answer. You made a gain, and in the eyes of the tax man, that profit is income. So what now? What's the damage going to be, and is there really anything you can do about it? The short answer is a big yes. But first, we need to be clear on what we're actually talking about. That profit from your sale has an official name. It's called a capital gain. It's basically the selling price minus what you originally paid for the house. And this isn't just some number for your records. It's considered real taxable income. But don't start worrying, because there is a very powerful tool designed to help you with exactly this. So, how do we tackle this tax? Well, let me introduce you to your new best friend, Section 54 of India's Income Tax Act. Now I know, Section 54 sounds like boring tax jargon, but trust me, this one is different. It's a rule made specifically to give homeowners like you a break. And here's the really cool thing. The whole idea behind this law, the government gets it. They know that most people who sell their house aren't just trying to flip it for a quick buck. Nope, they're usually just trying to move into a new home. So Section 54 exists to make sure the tax bill doesn't become this huge hardship that stops you from buying your next place.
So here it is in a nutshell. Section 54 lets you claim an exemption, which is just a fancy word for a tax discount on your capital gains. But here's the catch. You have to reinvest the money from selling your old house into buying or building a new one. It's a deal specifically for people who are staying in the property market.
Now, of course, it's not a free-for-all. There are some very specific boxes you need to tick to qualify for this. So let's run through the checklist, starting with the property you just sold. This is rule number 1, and it's a big one. The house you sold must be what's called a long-term capital asset. For a house in India, that means you had to have owned it for more than 24 months, so more than 2 years. If you owned it for less time than that, Section 54 is off the table completely.
This little story makes it super clear. Look at the left side. Mr. Raj holds his house from 2016 to 2025. That's 9 years, way over the 24-month minimum. He's good to go. But on the right, he buys in 2024 and sells in 2025. That's less than 2 years, so it's a short-term gain. Sorry, Mr. Raj, no Section 54 for you. This holding period is absolutely non-negotiable.
Okay, this checklist really sums it all up. Let's walk through it. Who can claim it? An individual or a Hindu undivided family, so not a company. What did you sell? A residential house that you owned long-term. What do you have to buy? Another residential house. And where? The new place has to be in India. See? When you lay it out, it's pretty simple.
And just to hammer the point home, the law is super specific about this. Selling a house and buying a house, that works. But check out the right side. You can't sell gold to buy a house and use this section. And you can't sell your house to buy, say, a commercial shop. It has to be residential property to residential property. That's the only way.
Okay, so let's say you tick all those boxes. Fantastic! But the next part is just as important, if not more, the timing. You have a very specific window to use that money, and if you miss these deadlines, the whole tax benefit disappears. Poof, gone. So get your calendars out, because this is critical. The date you sell your old house is day 0. From there, you have a window. You can either buy a new house up to 1 year before that sale date or within 2 years after it. And if you're building from scratch, they give you a little more breathing room. You get 3 years after the sale to complete construction. Don't mess these dates up.
All right, we've got the rules, we've got the timelines. Let's get to the fun part. How much money are we actually talking about saving here? Let's crunch some numbers. The way this is calculated is actually really straightforward. Your tax exemption is simply the lower of two numbers. It's either your total capital gain or it's the amount you spent on the new property. Whichever of those two figures is smaller, that's the amount you don't have to pay tax on.
These examples show it perfectly. Over on the left, Mr. Raj's profit was 1 lakh. He put 80,000 into a new house. Since 80,000 is the lower number, that's his exemption. He still owes tax on the other 20,000. Now look at Mr. Kapoor on the right. Same 1 lakh profit, but he spent 1.2 lakhs on his new place. In this case, the gain is the lower number, so his entire 1 lakh profit is exempt. He pays 0 capital gains tax.
Now check this out. There's a really neat little clause that not everyone knows about. If your total capital gain is 2 crores or less, you get a special once-in-a-lifetime option. You can actually invest in 2 different houses instead of just one, and still get the full tax break. This is amazing for someone who wants to buy a primary home and maybe a smaller second property.
But there's a new rule you have to know about. This is a big change. To stop people with massive gains from writing off huge amounts, the government put a cap on it. The maximum investment you can claim an exemption on is now limited to 10 crore rupees. So even if your gain is, say, 15 crores and you buy a house for 15 crores, the tax benefit is capped at an investment of 10 crores.
Okay, you know the rules, you know the numbers. But honestly, knowing the rules is only half the battle. Applying them correctly and not falling into any traps, that's the other half. So let's wrap up with a few common mistakes and how you can avoid them.
This is probably the biggest trap of all. You did everything right. You claimed your exemption, you're in your new house, and then you get a great offer and decide to sell it after a year or two. What happens then? Well, there's a lock-in period, and you really need to respect it.
Here's the deal. You have to hold on to that new house for at least 3 years. If you sell it before that 3-year mark, the tax benefit you got is taken back. It's reversed. And the way they do it is sneaky. Your previously exempt profit gets subtracted from the cost of your new house, which means when you sell it, your taxable gain looks way bigger. It's a costly mistake to make.
And now for my favorite pro tip. What if your tax filing deadline is coming up, but you just haven't found the perfect new house yet? Are you stuck? Nope. You use something called the Capital Gains Account Scheme, or CGAS. You can park your profit in a special bank account. This lets you claim the full exemption on your tax return right now, and then you have your full 2 or 3 year window to withdraw that money and actually buy or build your house. It is an absolute lifesaver.
And that's really what it all comes down to. Section 54 is an incredible tool for homeowners. It's designed to help you, not hurt you. But you have to play by the rules, the timelines, the asset types, the lock-in periods. It all matters. So the big takeaway here is to plan, be meticulous, and make sure your next big move is also a smart one. Thanks for watching.